I'm Professor Wayne Archer, and happy to introduce our guest today. Jacques Gordon is the global strategist for LaSalle Investment Management. That's a group that manages on the order of $40 billion worth of real estate capital. That's with a B, 40 billion. Jacques directs the macro strategy and micro research as well for investment decisions in 30 countries. And he directs the investment strategy group, which analyzes capital markets and regional economies and property markets. So he's dealing at every level of the game. He has received an award that I'm familiar with and respect a great deal, the Graskamp Award, for his contributions to education in real estate. And those of us in the industry know his name well because of his contributions in that area. He has articles in Financial Times, the Journal of Portfolio Management. Some of you in finance are well aware of that journal, the Wharton Real Estate Review, and a host of other places. He has a PhD from someplace called MIT and master's from the London School of Economics and an undergraduate from Penn. And what we know him as mainly is a guy who is highly regarded in our circles. And there's not a person I know in my group who doesn't know Jacques and would not welcome him on any venue and for any event. So we are glad to have him here to talk to us about the world that he spends so much time with. Jacques, welcome, and it's all yours.
Well, thank you, Wayne, and it's really terrific to be here, and had a chance to meet with some of the students upstairs, some of you, so I warned them, and I'll warn you, to keep it interesting. I do not like to lecture. I like to have discussions. I like to find out what you all are thinking and hearing. So if you could hang with me, it's been my day started at 5 a.m. I've been just coming out of the Pension Real Estate Association meetings, so there's a lot of client mingling and partying that goes on. It's sort of not quite like your undergraduate St. Patty's Day parties I saw on University Avenue, but it's as close as 40-something and 50-something-year-old guys get to. So I was out late last night. I was up early this morning, and if I just lecture, I'll put myself to sleep. So I'm going to want you all to help raise the energy level and keep the room going. I have this enormous slide deck. I don't know how many of your presenters do that. I'm not going to force the slide deck on us. It's got some good stuff in it, I think. It'll help sort of keep the conversation going. I work for LaSalle Investment Management, as Wayne said. It's the investment management arm of Jones Lang LaSalle. Perhaps many of you are familiar with the company. Perhaps many of you are interested in careers there. We do have a pretty good website that explains how to do that. In fact, the students I met with, John, you knew the website better than I did and how the rules work. My area of expertise is really the investment management of pension fund, endowment, and increasingly high net worth capital in international real estate. So that's my topic today. If I can, one of these two pointers I was told works and one doesn't, and they don't, either one work. Where should I be pointing it? I can also just use the mouse. Should I just use the mouse?
We have a funny thing happen.
Well, we've gone on to the...
We've got a $30 million building here, but we can't seem to afford it.
All right, I'm good. Oh, the batteries. So here's sort of the topics that just to warm us up. In fact, where's Matthew? Matthew, where did I lose you? Oh, there you are. Matthew Price, is it? Rice, right. So what were you telling me you wanted to do with the master's and MS in real estate? What was your goal? Come on, Matthew. At least at one point. Development, okay. Well, appraisal you mentioned is something interesting. Consulting you would do, yeah. And I would just point out that while Florida's development industry might be kind of flat on its back, have you maybe noticed that other parts of the world are doing an awful lot of development? They are. So development expertise, for those of you that are interested in development, there is a great wide world of opportunity for that at not just international firms, but all kinds of sharpshooters who are interested in taking what they've done well, say, in the US and learning how to do it in other countries. It's not easy taking the American approach into another country. It helps to speak another language. It helps to know another country. But I know we hire a lot of people who come out of American schools, both MS programs and MBAs, and we consciously do take them to other countries just so they can expand their horizons. I think one of the things I'd like to leave you with is really right up here on this slide right here, which is that this local industry that we're all watching change after finance and automobiles and probably electronics, every other major industry has gone global. Real estate, with a good lag, as we always do, is also very much an international industry today. And even if you're going to be working in Miami and you already know your uncle's told you you've got the job, or your friend has told you you've got an in with the master plan home builder who's doing whatever, your finance could be international. Your tenants could be international. You may be building product that is going to be auctioned in an international capital market. So I would maintain, even if you're a total Florida local kind of person, you're going to want to open your eyes to the world of international real estate and how it works and what types of skills you need to compete in that marketplace. My big 4 reasons that I'll talk about today are why that's happening. And the 4 that I'm putting up there are something that's already, I know in your other classes, both undergraduate and graduate, you've learned a lot about the way the world is more interconnected. You've all read Thomas Friedman. You've all been reading and seeing year by year the way in which the world is more interconnected economically. It's also, one might point out, through social networking and through the internet, interconnected in lots of ways besides economics, socially, culturally, all sorts of ways. But the economic integration is a big driver of international real estate. One of the ways that that economic integration starts to get investors more comfortable is that they've seen that blue chip stocks, some of their bond portfolios international, and increasingly all their other asset classes are international. And they're starting to say, well, how about real estate? Shouldn't I hold a market basket of global real estate much the way I do with my stocks, my bonds, even commodities? So what we've seen is steadily, with occasional blips downward, as happened in the global financial crisis, but a secular trend has been more and more cross-border investment flows, both on the debt and the equity side, that would lead to a conclusion, I would say, that international is going to continue to be a major trend in the industry for those of you with a finance bent. Finally, I'd say both a big change for me in my 30 years in the business has been, used to be real estate was done locally and the service providers were local and the whole business was very local. But that's changed. And while firms went first regional, then they went national, now many of us are going, not all of us, but many of us are going international. So firms like Jones Lang LaSalle are making it a big point to have the kinds of presentations I'm going to show you today and the kind of dialogue I hope we'll have be part of what all of our employees are able to do. Even if their client is Procter & Gamble in Cincinnati for the corporate headquarters lease. Turns out Procter & Gamble is also we're in 30 countries as an investor, 60 countries as a service provider. Procter & Gamble's got us beat. They're in 105 countries, and we are their major outsourced real estate provider. And if you're going to work for Procter & Gamble as your client, you might need to know a little bit about international, even if you're responsible for the headquarters lease in downtown Cincinnati. So these are the ideas that I'd like to share with you. The final one is one that I hope all good business schools are teaching. I hope you're bringing in ethics into some of your classes and the way to be a good corporate citizen, the way to be a good participant in a market. There are codes of conduct. There are good standards of practice. And so I will also share with you some of the work that our company has done on what we call a transparency index. It's up online, and you can read for yourself there the way in which we look at the notion of rising standards of real estate, transparency in all of its forms, not just corruption or anti-corruption, but also the way in which real estate data is used and disclosed, and the way in which transaction processes occur, and the way the legal process is conducted in a country or in a market. So our firm is one that I think you would not hire if you just didn't care how the work was done and you were the kind of investor or owner that said, hey, just get the building leased and I won't ask you any questions about what bribes you paid or which junket trips to Las Vegas you had to do or what mayor in Shanghai you paid off. There are firms that are quite fine with that, but not ours. Each of us every year sign a code of ethics, and every year I can't even get onto my computer if I haven't gone in, and they change the code of ethics every year, and they make sure you read it because they give you a little quiz on it. It's like if you've ever got points on your driver's license and you have to go back to driver's ed school, it's like that. You can't get onto your computer until you've gone back through the new code of ethics, which is very similar to the one the year before, but just rearranged and shown that you read it, understand it, and ascribe to it. So I just mentioned these kinds of things. Our particular corporate style, it's not every company's style, and there's still a big role for those of you that want to be entrepreneurial sharpshooters in your local market. You'll do great. But there's also this other side of the business that's going international. So that was my speech on that. Let's just see if I can get this to go forward. There we go. So I'm here on St. Patrick's Day. I wanted to just tell you how glad I was to be here. And you go, wow, you're missing St. Patty's Day in Chicago where they turn the river green. Boy, you must be really bummed out about that. Actually, I'm not at all. It's very nice to be down here. And this is actually a picture of Lakeshore Drive just 4 weeks ago. This is February 17th. They closed the drive. We had a big dump of snow. So this is just my way of letting you know how happy I am to be down. This is the nicest weather I've had all year. It's been a tough winter. But it's also a chance for me to say, even in cities like Chicago, places like Miami or Gainesville, you get a lot of cool interconnections and interactions when you start to open up your mind to the way other countries are modernizing and joining the modern world, if you want to call it that. This is just a great picture that I had to tell my driver to pull over so I could just snap this picture on a recent trip to New Delhi, and in Gurgaon, which is on the other side of the river from New Delhi. It's a large master plan community with just gorgeous roads, great curb cuts. You can see wonderful curbs here, right? And terrific four-lane traffic patterns and magnificent shiny buildings everywhere popping up. And these guys cruising down the middle of the street. And, you know, that's a lot of what's cool to me about international real estate. You learn so much. You open up your mind. I wished I'd talked to these guys and said, what's with this cow-driven thing, you know? But it's really one of the things that I think is so interesting talking to. Where's Yuan? Are you here? Raise your hand. There you are. We were just talking about you growing up in, where did you grow up? Who else here holds a non-U.S. passport? Bunch of you guys. What countries are you from, please? What part? Beijing. A couple Beijingers. Okay. Where else? Also, so three at least. Sir. Oh yeah. Very good. Yeah. Greece. Good man. You're still in the EU, but you're hanging by a thread. What are some other passports here? Yes? Cuba? Seriously? Wow. You hold a Cuba passport? Yeah. It's not like your parents got out on a boat and yeah, that's very cool. Wow. So are we going to be able to trade with you guys someday soon? Can we go start buying real estate there? Yeah, it could. That could be a very cool thing in the next 5 years. Got to wait for, change of leadership there and a few other things, but yeah. Okay, who else? What other? Venezuela, very good. And Ghana. And who did I miss? Anybody else? Other passports? All right. I won't embarrass the Americans by saying how many of these countries that you just heard about have you been to, because I'm guessing some of you haven't been to these countries. I haven't been to all your countries. So, but I just do think it's kind of a very cool thing. If you're in the world of business, you're getting a graduate degree in real estate, and you haven't thought about international as part of what you want to add to your toolkit before you leave here, I'd suggest you do, because I think it's really going to be a big opportunity for our industry, and I'd say we're probably in, like, I don't know, the second inning of the internationalization process. If you've got, I don't know, the Lexus and the olive tree sort of tells you automotive is very international, or finance is incredibly international. We're just getting going, just getting started. The best talent out of American schools is needed in emerging markets. It's needed to help run the financial models. It's needed to help understand how some of the best modern practices can be applied, even in places like Beijing, where they actually have tons of engineering talent in Beijing. I think you said it yourself. It's not engineering that they're missing so much in China. It's really understanding how all the finance pieces work together. And that's really, I would agree with our joint venture partners we're working with in China. They're all engineers, and they've got great backgrounds in engineering. But when it comes to a discounted cash flow modeling using, say, Argus or whatever, it's all brand new to them. So if you've got that skill and you take it back to China, you'll be very valuable. So this is just one of many charts I've got. If you weren't convinced that the world's economically integrating, this is just the last 10 years, and look at that upward trend. Look at how there was a blip. Sure, in 2009, the world wasn't trading with each other as much. The world wasn't going cross-border as much, and that was a plain hard fact. There was a lot of transactions that were put on hold or blew up in the GFC, as we call it. But since then, it's been rapidly back on track. You'll remember from your Econ 101 what good things happen with your comparative advantage theory of two countries, one with a specialized advantage in one thing and another in another area, and they both trade. They're both better off. Remember that? Well, it happens all the time in the financial markets, so I won't belabor that. But I think it's just important to kind of keep these pictures in mind as you think about why international might be worth spending some time on before you leave. Yeah, please.
Could you go back real quick?
Yeah.
A lot of the growth was actually in a forecast.
This is WTO. Yeah, and Global Insight, both. WTO keeps good track of this stuff, World Trade Organization. And countries keep joining the WTO. It was a big deal when China joined the WTO, and it really blew the doors off of China. If you say there's one thing economists would point to about what really cranked up China's growth, it was their joining the WTO. Yeah, it's a good question. Yeah, the forecast is going up. The real numbers are pretty good through the end of 2010. Who knows with the earthquake and what's going on right now exactly how the rest of 2011 plays out. But you know, certainly as a trained researcher myself, I'm always interested in the long-term trend. And I know that there are going to be blips, and I know that there's going to be a cycle overlay, but if I can find a secular trend, a major trend that's got 8, 10, 20 years going for it, I really want to understand it. And this movement to trade more and more and get more economically integrated, that's a trend that's been going on for hundreds of years. And recently, it's picked up pace even more. So I'm not going to bet against this trend myself. Now, here's some pictures, too, of just to kind of share with you a little bit about the world I'm in. Let me ask you guys this. And I wasn't quite sure, just talking to the students, just how many of you were interested in this business. But how many of you here would be interested in real estate in the investment management business as opposed to the development business or the brokerage or the leasing or the transaction business? So the investment management business. Anybody here? There's a couple of you, one or two. Some of you are interested in whatever job you can get. I understand that, but it's getting better out there. So, okay. Well, these next series of slides just are a little window into my world. My clients are pension funds, endowments, as I said, and increasingly 401k plans, mutual funds, because there's a large trend over toward more and more retirement money going into those defined contribution plans, so the money has to be flexible, and it really isn't a securities basket, that money is much more comfortable in real estate rather than just buying into, say, Leo Wells' latest syndicated deal with a 3% brokerage load. Nothing against Leo Wells, but just picking him out as one of many syndicators who are tapping into high net worth money. The other way that individual mom and pops in many countries are starting to realize is a smarter way to invest is getting the best professional management company listed on a major stock exchange and investing in those companies just the way they would the best aerospace or the best technology companies. And I think that's also another secular trend that is just, you can try to bet against it if you want, and short term there's always going to be a local private guy who's good. But over time, if you're thinking about cost of capital and where the money is, it will increasingly gravitate toward these listed companies that are professionally run, highly transparent, not just in the US, but all over the world. So this is just a picture of what we're talking about here, the asset class that you deal with. These numbers do change month to month. I don't even know what date I pulled this data down. It was probably January. This global stock market has grown and then shrunk since then. Securities is, I think, probably still right in the 1.2 trillion market cap. I do watch those numbers almost weekly. Commercial real estate, no one's quite sure. Our own estimates is 6 trillion. Certainly a lot of different ways to measure that. These are big numbers. Why show them to you? Why think about it? Because what you're trying to do is understand real estate as an asset class, not just as an industry, not just as a place to earn a brokerage commission, not just a place to go develop buildings, but how the money comes into our industry and how it's put to work there. That's why I'm showing you these. And you can see that the 6 trillion is actually a very small part of the institutionally managed, for investment purposes, part of the larger pie. The 34 trillion is a very crude estimate of how much commercial, not just single-family housing pulled out, but multifamily rental is in, but also any vertical government building with a person in it is in the 34 trillion. Just to explain to you what's going on. So of the 34 trillion, and it's like a square foot, we kind of have done enough of estimates in about 8 countries and then extrapolated to 100 countries, how much real estate has been built by square footage. Their government construction stats on that. They're not very good in Ghana, I'm afraid to say, but they're very good in other countries. And you can kind of go with that and say, well, what's that worth? And that's where the 34 trillion. Doesn't mean that an investor owns it. In fact, corporations own a lot of their own real estate. Families own a lot of real estate. Governments own a lot of real estate. Some would say too much. That's all in the 34 trillion. Only a piece of that has migrated into this world that I'm in of institutional money managed, professionally managed real estate. So why show you these pictures? It's because what you may not know is the way in which that looks globally. Those pictures I just showed you are global estimates. Asset allocators need to see that stuff because they're trying to figure out how much to go into stocks, bonds, and other. Real estate's part of a growing basket of alternatives that includes commodities, includes hedge funds, includes all kinds of private equity, LBO funds, and real estate. We generally pick up an allocation of an institution of somewhere between 5 and 15%. The average right now for large pension funds in the U.S. turns out to be about 5%. But many of them are bullish on real estate. They're worried about inflation and are pushing that 5% up to 10. And it does vary. And there are some that are even more bullish and have pushed it up to 12. I've got one client, the Alaska Permanent Fund, they're at 12. They like real estate. They understand it. It's done well for them. They've got great managers who run it for them and do well, like us. And so they're at 12. But many are below that. But here's something, as you're kind of digesting this picture I got up, anything strike you about it? Anybody? You guys paying attention? Anything unusual that would strike you about just comparing the 6 trillion and how it plays out? Give me some ideas here. About 20 things come into my head that I would say about these charts, but one idea, sir, what comes to your mind? Anything. Half is in America. Less than half, yeah. That's a good one. And here's something interesting, Matthew. You may not have, totally know how much you hit the nail on the head with that comment. Half was in America in the listed sector 6 years ago. Just 6 years ago. So 6 years ago, you go back to about 2005 and you take the EPRA NAREIT country weights and you do this pie chart, you come up with about 53% were in U.S., just U.S. And then you roll the clock forward just these number of years, a bunch of big companies like Equity Office Properties gets bought up by Blackstone and split up, and a few others, Archstone, go off the exchange, and GGP blows up. All kinds of weird stuff happens in the U.S. REIT sector. And all these other countries start to list. Who here was Venezuela? Do you have listed real estate? Do you have listed real estate? Do you have listed real estate? Do you have companies that are on the Venezuelan stock exchange? No? Well, your neighbor to the south does. Brazil, they love it. Brazil's, I know Colombia's just getting started. I think they've got 2 or 3. I don't know about Venezuela, like I said. Yeah. Well, in Brazil, it's been a big growth part of the industry. Here's the thing. Anybody here been working in the banking sector or interested in the banking sector? Anybody? A couple of you guys? 3 or 4? No women in banking? Banking's a cool industry. Banking and real estate have a real interesting history. I would recommend you look at it. These countries that are growing need to be banked, and their access to the capital market is often New York City or Miami. It doesn't have to be that you've got to go live in Caracas to bank these guys. So it's just something to think about. If you're interested in being in the international real estate flow, where the growth is, the banking industry is the intermediary that gets these growing companies access to capital. So Citigroup or Bank of America would be a lead underwriter of an IPO in Brazil, because emerging market stocks are hot all around the world, and if they just go with a local underwriter, they're not going to tap into all that capital. So it's just something to be thinking about. This move from 52% to what's the market share for U.S.? Can you read it to me? Anybody? What's it? 35. That came not because of the U.S. collapse so much, because actually for the 2 or 3 companies that left the exchange, another 5 or 6 came on. It was the explosion of new companies that listed in Hong Kong, Guangzhou, not Guangzhou, Shenzhen, there's an exchange now. Shenzhen, and where's the big exchange? Shanghai, yeah, your competitor city to Beijing. So Shanghai IPOs have been huge in the last 6 years, and Hong Kong. Okay, so we get the idea here. That's the picture I wanted you to take away was kind of where you were going, Matt, is that it's not a US-centric picture, is it? It's a very balanced picture, isn't it? And the big money management companies and the big I-banks are looking at this picture and going, where's my market share in the US? It's huge. We got the US covered. What's my market share in China? What's it in India? It's nothing. Where's the growth? It's there. So I want to hire people who can help me grow that market share. And I want to hire local folks, but I also want to hire people who understand America, because that's basically still where the money is. It's going to fund a lot of this. So this is what I take away from the picture. Now, others, technical charts, ways that asset allocators think. If they're thinking they would like to go global in real estate, they're going to want to know a lot more about it. They've looked at the literature, they've understood what going global means in stocks, they've understood what it means in bonds. They don't know very much about going global in real estate. So this is the area of interest for the academics. This is a literature that needs to be developed, it needs to be published, it needs to be better accepted in the CFA world of people who study the behavior investments in a portfolio context. It's a small literature, it's growing. I've contributed in a very modest way to it, Wayne, not much, and I don't view that as my big job. But this is something I think when I look at what's been being published now in the academic literature, it's really catching up fast. There's a lot of good stuff being put out on international. And it is going to help the CFAs of the world, who are the gatekeepers and the asset allocators of the world, understand things like correlation, efficient frontier, and what needs to happen to figure out if real estate is going to be a domestic-only asset class, as it generally has been treated that way by many pension funds, or is it going to go global? Now, I can tell you that decision has already been made by a lot of US pension funds. But it hasn't been made, here's something interesting, hasn't been made by a lot of where the money is in America today, which is in the 401k sector. So international real estate is underrepresented in 401ks as an option. Most folks, when they pick an election in real estate, will pick the Fidelity or Vanguard US REIT Index Fund, ETF, or a basket that Fidelity actively manages, this only US only, and they're missing this larger world. Now that's changing, and the fastest growing area in mutual funds has been emerging market funds and international real estate. So just to give you a sense of how quickly these shifts are happening. But these types of correlations, looking at how real estate fits in a portfolio with stocks and bonds, looking at how listed real estate and direct real estate fit, this is all pieces of the puzzle. This is the risk-return space, just showing those four major asset classes. Listed real estate has some problems. Listed real estate does not have 20 years of track record that's very, very good looking. Look at it. What do you see about it? Well, actually, its returns are pretty good. What's it hurting on? Yeah, it's getting killed. And you know what? If you've ever bought one of those stocks and held it, you lived through that. These are huge standard deviations. 30% is very high. But if you think about any of the big tickers just in the US, one I follow, just because I know the CEO pretty well, or the former CEO, is General Growth. It was the second largest mall company. It went for years at $30 a share, then it went up to 35, then it got up to 40. Then it traded during the global financial crisis down to 10, then down to 5. It actually, for a week, was trading at $1. This is a big company. This is an institutional company that was in S&P 500. This is a company that was in the indices. Everybody owned it. You had to own it. It was in the index. And just think of that volatility on a major U.S. company. Now you go to China. You look at that volatility. It's also earth-shattering. Not maybe as dramatic as $45 down to $1, but pretty much the same way. Now, General Growth, by the way, is back up to like 15 today, so it came back from the dead. If you bought it at $1, you would have made 15 times your money. So, and you can have some of those same rocket rides buying Hong Kong property companies, can't you? They're amazingly volatile. So this is a problem. It's something that we're still trying to understand as an industry, as an asset class. One thing I tell my clients is, look, if you're a long-term investor and can stomach some of that volatility, look at the volatility of the earnings. That's different than the volatility of the stock price. And that's really something to focus on. Vanke. Tell me what Vanke is. You know Vanke? Anybody know Vanke? It's China's largest listed home builder. They're the ones, remember them in 2009, there was a riot in their offices because well, anyway, there was a long line of people trying to buy homes and back before the crash, and they weren't satisfying everybody's desire to buy a condo, and when they sold out, there was a riot. It was that, I mean, how often do we have that in America? Those of you who work in housing, wouldn't you like that? You got a line of people outside your marketing office, and you can't, and you've sold every last unit, and the unmet needs rioting because they can't buy in. It's an amazing story of Vanke. Why was I talking about Vanke? Tell me. You have no idea. I don't. Oh, it's volatility. It's a crazy volatile company, and it's in the home building business. It's like Beazer Home. And it's stock up and it's down, and it's in this index, and that's part of the problem. How about home builders in the U.S.? You want them in the same index as REITs? REITs that have tenant earnings coming in every month with tenant, and they're in there with Beazer? No, we wouldn't allow it. We have a REIT index, and we don't want Beazer in it. But in China, it's less clear, and people are just so hungry for real estate, the real estate index has Vanke in it, V-A-N-K-E. Go check out the company's website. It's pretty cool. It's a neat company. Okay, so at any rate, how long am I supposed to talk? Till what? Hour and a half? Okay. Well, what I'm trying to do too is just get you all to help me with a little bit more energy, if I could. So here's some slides that are just helping you see how we are trying to put out there for our clients an understanding that when you invest in real estate, it's no longer just about investing domestically, but as you start to go international, it isn't always just about going to buy shares of Vanke and watching your money go all over the place. There's also good places in between to go. We call it the low, low, low world, which is actually lower growth, lower interest rate, lower inflation. I didn't put it up there, but I believe it. It's also lower risk, lower volatility. Then you have your grow, grow, grow countries. There's a great bunch of countries. They're not just the wild, wild east of Vanke, but they're also good, solid companies out of Hong Kong. Great companies with good earnings that don't have riots on the street and don't have very volatile stocks. And it's not just in China, it's in these other countries, the Indias, the Brazils. Also, you can ride the growth of China in Australia just fine or in Singapore just fine. So these are two very different styles of investing in real estate, and they need to be looked at differently. So this slow growth and high growth comparison, you think about it here in the US, we have the same thing with our Sun Belt down here versus my Rust Belt in Chicago. It's just different rates of growth mean you're going to want to invest differently. And that's very true. I would never advise somebody to do an office, major office development or investment play in Chicago, my hometown, even though that's where my office is. It's just not a market that has performed very well over the years. But we're actually doing a lot in Miami. We think Miami's got hit hard, down hard, and will grow again and be a great place to invest. So to what extent you're looking for value investing or growth investing, that applies internationally just as much. So what I've got in the next set of slides are kind of highlights of what we tell our clients, which is summarized in this once-a-year document that we send out to them electronically in December. I've got copies for you all if you're interested, and it's really just sort of like, well, some of our clients have called it sort of their investment guide to international real estate. There's maybe only one or two other firms that cover as many different countries as we do. We've been doing it a long time, and we're really proud of the way that we're helping guide our clients to pick countries, property types, cities, styles of investing, and to try to develop a plan to invest their real estate dollars in the year ahead. So this is what this document is. As you might imagine, with my research background, I always start with the macro view. These are the kinds of ideas that I'm going to share with my clients. Yes, you know, we have to update these things, right? So Japan is starting to shake. We've got to watch that very carefully. And Wayne, I'm sorry when you came to pick me up, I was a little late getting downstairs. I was managing huge volumes of email coming into my computer, turning around and sending it back out to clients once I cleaned it up, dealing with what's going on right now with our Japan investments. So I'll try to share with you some of that thinking. The generalizable thing I'd like to leave you with is that as you're reading any market, and particularly a country you maybe don't know very well, you always need to start with what is going on with the economy, because the real estate is just going to house that economic activity. So I always want my clients to be thinking about the economic cycle first. Then I'm going to want them to understand the relationship between that economic cycle and the underlying property market that generally lags it, but often has its own quirks to it, and to think about those two together. But the most important thing my clients and I have learned over the last 10 years, I wished I'd understood this better 20 years ago, is that probably the biggest overlay in the short-term performance is really the capital markets overlay. Less of an important driver of performance maybe over 5 or 10 years, but over 1 to 3, which is most of these guys' careers. They get paid bonuses or not. Pension fund endowment people, it's all about their 1 year, their 3-year performance. Fortunately, not many of them are quarter to quarter, but many of them really do care about 1 and 3 years. And I, as an investment manager, care about it, because I'm going to get fired if I underperform year after year. And I keep saying, just wait for the capital markets to come back. Just give me another 5 years, and it's going to be fine. I'll be gone. I'll be fired. So these 3 cycles, which is a way we're reading pretty much any country, operate very differently in very different countries. One of the ways that's interesting to me now is the way they're operating and starting to link up more and more on the capital markets. Not always, not perfectly, but the capital markets are by far the most global of these 3. So when you had a credit bubble in '06, it wasn't just a US credit bubble. It was in Ireland, it was in Spain, it was in a lot of countries. The economic cycles were not as connected, and the property markets were even much less connected. But this is a way that as you go international, you've got to realize that there are these linkages that don't give you all the diversification you might like, even though it seems like buying an office building in Hong Kong should have nothing to do with New York, until you realize that you had Merrill Lynch as a tenant in both, and they were both in the financial services industry, and they both got killed big time in the first quarter of 2009. But what you may not have been clever enough to think about is coming out of that, Hong Kong recovered, and New York is still barely inching along. So there are differences, but also similarities. Yeah? Well, let's just look at some of the countries. It's a good segue to what I thought I'd do is just give you an example with Japan, which is a tough one to read right now, but it's on my mind. I'm trying to figure out Japan like right now. I'm trying to figure it out because we were underweight in our securities portfolio in J-REITs. going into this, and then they fell 10% in value in 2 trading sessions. Then they bounced back 5% yesterday, and I don't even know tonight when we're asleep what's going to happen. So I'm getting these emails from my trading guys saying, what should we do, what should we do? And I'm saying, go back to those 3 slides. Let's look at them. Let's see what's going on with these 3. I go back to my basic principles. And I say, get out of the heat of the moment, because we're not a trading firm, and just try to figure out, have we got good relative value in Japan or not, looking at securities and also looking at private equity, because we have a lot there too. So that's the idea I was going with, to go through that where are they in the cycle? 30 countries times 3 cycles. We're in 90 different position answers that I'm not going to have time for. But in this document, we do try to cover that. And the way those 3 different positions times all those different markets line up and then are priced, that's really what you want to do as you're building a global portfolio. So there in like 3 sentences, I told you the key to success in global real estate money management, I think. It's worked well for us, I'll say that. We're outperforming most of the indices. So last week, March 11th, a date Japanese people will always remember, major event. And these are some of the numbers that people are starting to talk about. It's a little too early to know for sure, but these are the kinds of numbers we're starting to already build into our models, and our models price the stocks. They also price the private equity. We're pricing the stocks generally weekly, or doing an intrinsic value update weekly. The private equity, we're generally doing that quarterly. So we've just coming in at the end of the quarter, as it turns out, we were coming into the valuation for private equity. So we're trying to figure out what are we going to value these things at, because if we can sell them for more than we value them, we're going to sell them. And if we think they're cheap relative, if our value is such that it's much higher than the surrounding market will sell them to us, then we're going to be buying. See how that works? So here's what we right now are thinking. Japan went into this in a very fragile state, very much at the lowest end of that low group of countries. It actually put up some good numbers in Q3, like a 2%, 2.5% growth. Oh, actually, for 1 quarter, it was actually running almost 3.5% GDP growth, but it was all on technicals. Its economy was very much a sputtering along, kind of at the bottom of that trough, and yet it wasn't clear to us that they were ever going to pull themselves out and get a more consumption-oriented balance, as opposed to years and decades now of export orientation. And as an exporter, they're getting killed by Vietnam, by China, by everybody else. So to build their entire macroeconomic growth on export-driven people buying their electronics and their cars is not going to work for them. They need to find something else to get them going. And they still hadn't found it, and they had a lot of structural problems in their economy, just even before the earthquake. Earthquake comes, now what? Now what do you do? Well, right now what we're thinking at the moment is very crude, is that they're going to go into a very sharp recession for 2 quarters. The rebuilding program, just as we've seen with Katrina, as we've seen with the Kobe earthquake, is actually a boost, a stimulus to the economy. So they're actually going to come back stronger in Q3 and Q4. Overall, it's a big negative for the economy in 2011, but they can, if they use the crisis as an opportunity to reform, they can actually come out stronger. We don't know if they will. We don't know if the political will be there. We don't know if the reform that the world has been sometimes waiting 20 years for. In the case of redistribution of goods, we have a lot of warehouses there. We notice that the old-fashioned 4 intermediaries, as it leaves the factory before it goes to the store, 4 different people touch it, and it's very inefficient. We'd like it to get more like a 3PL modern logistics model, because then they would come into our warehouses and we'd be a beneficiary. But that's a good example of one of many reforms that Japan has been slow to put into place. It's a country that really values tradition, values cultural relationships, even ahead of economics sometimes. And that shows up in the political sphere and the economic sphere. So this is one picture we're dealing with. Now, what else is going on? Well, here's a weird thing. This is the other thing about international investing that's so fascinating. Something can happen in Sendai, Japan, and the law of unintended consequences just starts popping up everywhere. Who would have thought that with this country down on its knees, the yen would appreciate? I wouldn't have thought that. I would have thought the yen would plummet. Instead, the yen, maybe a currency trader would have figured it out, and I'm not a currency trader. The yen's appreciating right now. It's appreciating as cash pours into the country, as cash is repatriated from companies and from banks who are going, oh, we better get all the money we can back into Tokyo because we're going to need it there. We don't need it in New York. We don't need it in Paris. And all that cash coming back means that they're buying yen and selling dollars and selling euros, and that's popping up the yen, which is actually good for us because we own a bunch of yen assets. So we're going, yeah, go yen. But then look at the 10-year Treasury note. It's doing the same thing the T-bond is doing, and it's rallying because people are worried about stocks, and so the Nikkei is down an enormous amount. Something like $650 billion of value was wiped off the Nikkei in 24 hours. And a lot of that money is going over to the JGB. Now that's also good for real estate because real estate has tended to trade as a spread over the bond. So I got two numbers up here I'm pretty happy about. That's kind of not what I was expecting out of an earthquake. But there are other things that aren't so good. And here's another law of unintended consequences. We're along Calgary. And after the tar sands, the number one thing that drives Calgary is the uranium mining business. And the uranium mining business is also going, geez, who's going to be buying my uranium ore over the next 10 years? So another very interesting kind of dynamic that I'm just bringing into the equation here. The larger thing for Japan that we are worried about is how they're going to meet their power needs going forward. And even after they put these fires out, how are the industrial heartland cities of Nagoya and the real Yokohamas and the parts of where most of the Nissan and Hondas and Toyotas do their manufacturing, how are they going to go back to what they used to do? Because remember I said this is an export-driven economy. So I've showed you two positives. I've got a big negative, which is the rent in the buildings we own if they're connected to the Osaka, Nagoya, coming down 10% in production and 20%, 30% in profits, and they can't pay our rent, and these are the suppliers, that's going to be a big hit. And we're very worried about that. So yes, I'm sorry. I'm not a uranium expert, sir. I couldn't even tell you. What is it, March to what?
Well, after August, I mean, it goes up from, $45.
No, it's part of well, two things. I actually do know this one. A capital markets effect, which is that commodities are the darling of many investors who are worried about inflation. And uranium ore is part of a basket of commodities that show up in commodities exchanges along with gold and other rare earth metals that we've been reading about. So it's benefiting with capital markets. Also think about what was going on with oil, right? So the demand for uranium ore was going way up because oil was going up, and our country and all countries were thinking, how do we diversify out of fossil fuel? So that, I'm pretty sure, I'm not a uranium ore trader. Yeah. Yeah, no, this is like way outside of my pay grade. I don't even know anything about uranium ore. But what I do know is that what can happen in Japan can affect Canada. because it turns out Canada, one of its biggest parts of its GDP is natural resources. And one of their biggest export countries, China's #1 for them, #2 is Japan. So this is just another way that international gets very interesting, but also I'm not now just interested in my Japan portfolio. Now I'm interested in my Calgary office buildings and all the other stuff we have up in Calgary that are going to be fed by the folks that churn iron ore out of the ground and refine it or do whatever you do with uranium ore. Okay, so here's where we are now. Now I'm back to the U.S. I'm watching this literal tsunami hit Japan, and then it comes all the way over to us, and it's now going to affect my U.S. real estate portfolio. And all of this I got to keep in mind because I want to be giving my clients the best advice on what to do with their REITs, what to do with their private equity, which is harder to move and more costly to move. They can sell those REITs like in 5 seconds. They can't do that with their private equity, but they want to start repositioning. Here's another interesting thing we're noticing is what's happened with the long bond. And the long bond in the U.S., just as it is in Japan, is often a benchmark that many investors use to figure out what their other investments should be doing. Real estate is certainly one. So with the long bond rallying in the U.S., as the world gets nervous, it'll be interesting to see how that will affect capital demand for real estate. Now, what do you all think would happen? Anybody? Long bond rallies, so it got up to 3.7 in January. Then we started to have an oil price shock, and Egypt and Tunisia happened, and it went down to 3.4. And today it's down to 3.1. What do you think? Give me something here. Anybody? What would it mean for real estate if the long bond's at 3.1? If you're a yield investor, if you're looking for income, it might look more attractive. It might. Yeah. If you're borrowing and your cost of capital is pegged to not just short-term money market rates, which are also incredibly low, but to intermediate term rates, your cost of borrowing may fall as well. So you've got some interesting dynamics going on. While you're worried about nuclear power and you're worried about Japan and you're worried about GDP, as a real estate guy, you're going, wow, something interesting just happened. The long bond just went to 3.1. Is it going to stay there? That's something else I'd want to know. Or is this just like a one-week panic? And what should I be doing? Should I be out scurrying on the phone with my lender, locking in some good rate like this week? So that's the kind of email buzz on my email traffic on my company right now. And they're talking about this. They're talking about loans that they were going to be getting in April. Maybe they should hurry up and get them like right now because they are benchmarked to a 5-year or some intermediate note. So anyway, this is just a little example on sort of, you asked where are we in the cycle? We're all over the place. This is a very, very confusing time, but it's an interesting time. The capital markets cycle was roaring up until the last week. There's so much liquidity. I would say it's still roaring. There's a lot of capital. That little bubble chart I had, or the little bouncing balls, that was true. That orange ball was well ahead of both economies and property markets. There's a ton of liquidity. Central banks are printing money like crazy everywhere. They're only tapping a little bit on the brake, Bank of China, just a little bit of a little tap because they're a little worried about inflation. I guess it costs more to buy rice or bread in China this year than last year, so they're tapping a little bit. But in general, there's liquidity in China just as there is everywhere. That liquidity is well ahead of, scarily ahead of fundamentals in either the economy or the property market. And that's sort of my general global read, but each country is different. And you want to read all three of those things. So I have lots and lots of slides. I'm a very talkative guy, but I've done okay getting this group to talk. I did this up at Chapel Hill just a month ago with Hartzell, and it was just as hard. It was a bigger audience, though. And what I did there, which I'm going to make you guys do, is do some quizzes just to see how smart you all are. How about this quiz? The world's largest real estate company listed on a stock exchange. Simon Properties. Good guess. It's wrong, but it's a good guess. It's actually up in the top 5, so that's why it's a good guess. So the world's largest listed real estate company, please. Other ideas, just throw them out. It's not General Growth. I'll give you a hint right there. McDonald's. Wow, good idea. So you caught me. I want it to be a majority of its earnings directly from real estate. So it's a little harder to say that all those McDonald's earnings are from real estate, although many of them are. And the franchisee earnings that come into Oak Brook, Illinois, are partly rent on McDonald-owned premises. Not very much, though, because McDonald's doesn't own that much real estate. And the franchisees own more of it now than used to be, because McDonald's is wised up. They didn't want all the real estate sitting on their balance sheet. They even thought of doing a McDonald's REIT, where there was just going to be, like, every McDonald's was in it. But then, I guess, the FASB or some accountant said, no, actually, what you're doing there isn't a real deal. Or I don't know. I wasn't following it. But anyway, that's a good clarification, because there are some very large companies that are conglomerates, particularly in Hong Kong, like Li Ka-shing's company. Well, you've got a bunch of them. And there's Hutchison Whampoa. Say that right? It's got an enormous market cap, and they own ships, and they own gantry cranes, and they own warehouses. But most of their earnings isn't in real estate. It's like 20%. So I'm going off of the EPRA-NAREIT definitions, which is you've got to have at least 51% of your earnings from real estate. So McDonald's wouldn't fit, and Hutchison Whampoa comes close but isn't strong enough. And many of other sort of the Li Ka-shing type investments don't, because they own mobile phone company. Carlos Slim, world's richest guy, owns a ton of real estate, but he also doesn't get most of his earnings from it. He gets it from Telemex. Right? He's the richest guy. You knew that? According to Forbes. Okay, so other guesses, please. No peeking. You're looking at the answer key. That's why I didn't hand it out. Okay, come on. Those of you, well, how many people from China here? You guys should know this. This is some deal flow numbers. These are just some different countries that we follow. I'm clicking through these charts just to get to the answer. Well, let me ask you guys this. Easier way to ask it, because this is kind of an obscure thing, and when I tell you the answer, you're not going to go, oh yeah, them. You might, but most people won't. Of the top 10 listed companies, how many are American? Just roughly. 4, okay. 2? You guys are, 2 is closer than 4 to the correct. How many are Asian? How many are Asian? Or Asia Pac? 7. 7, I gave you that answer. This is a chart that I was going to dwell on. I was just trying to get to the punchline of the world's largest real estate company. Those of you who are interested in development, you don't really have much of a prayer in America right now for office buildings. If you want to get into healthcare real estate, lab space, education, you're in great shape. So healthcare real estate, even student housing, I think, has got some decent construction numbers to it. Most other sectors are flat on their back, with the exception of multifamily, which is coming back a bit in the U.S. But if you really have a passion for development, think about these are the places you want to go. Or, actually, as I look at it, they're the places you did want to go. Because look at Dubai. Singapore is still a place you want to go. All right. So some other, I've got too many slides here. I apologize. And I do want to think about wrapping up at some point. And here we go. So, okay. Here's my setup to the world's largest real estate company. I was hoping somebody would say, oh, it must be Jones Lang LaSalle. I was really, at least one brown noser out there. But how about CB Richard Ellis? Great company. That's our big rival. I was saying to Wayne, they're kind of like Hertz, and we're kind of like Avis. We're like number 2. You're right. It's a services business. Its market cap is good, but they don't have a lot of real estate on the balance sheet. They're like us. Our market cap is about $4 billion, Jones Lang LaSalle. CB's is about $6.5 billion. So big. Those are big numbers for what are basically the assets of those companies or human beings that could walk out the door. So like if Ernst & Young, who's working at Ernst & Young? You got a job offer there. Ernst & Young's assets, what are they? They're just like, they're people. The credentials and the ethics and the integrity of Ernst & Young, that's basically it. And that's more like what we're like. That's why someone was saying branding, why would you care? Well, you'd care when your assets are people and you're trying to project an aura of professionalism. That's why you care. Because you want to keep the people and you want to be hired based on your human capital, basically. So what is it, guys? Here's the answer. It's not one of these global private equity managers. This list, by the way, was also just to let you know there are a bunch of great US-based firms that do international real estate. Those of you who are interested in investment management, you should be interested in international. You should be familiar with these names. These are the ones who are doing international. There's also a much longer list of non-US headquarter companies that are doing international and doing it very well. I didn't even put them up. And I don't know why I put Public Storage up, except for it's got a big market cap and they're in 30 countries. Pretty cool. And we're in 60 countries as Jones Lang LaSalle, and CB Richard Ellis is only in 50, so we're beating them on that. But they do much more brokerage than we do. We do more investment management. Although they just bought, they didn't buy ING Clarion, but they bought the Asia Pacific and European money management part of ING, which is now going to make them larger than us on money management. We're at $45 billion right now, assets under management. CB's was at 20. They're going to rocket all the way up to 80 after that deal's done. So, is it one of these properties? These are some of the world's largest real estate companies. These are some names you should know. If you're going to be a banker, you're going to bank them. If you're going to be in a consulting or accounting, these are your clients. Westfield owns more regional malls in America than they do in Australia. They're an enormous, great company. Very good company. Brookfield is a great company. They own more real estate outside of Canada than they do inside. And if you're going to work for Brookfield, you might end up working for them in Miami, but their headquarters is Toronto, and they do a lot in Brazil. So you're just going to want to know that when you go into the interview. There it is. Who's heard of these guys? Sun Hung Kai? You have. Who are they? Who's Sun Hung Kai? What are they? Do you know anything about them? Yeah. There's a family of tycoons, right? Yeah. They're also listed, though. Well, when you say, why do you call them a tycoon? Would you say Simon Properties is a tycoon, Dave Simon? Why do you say tycoon? I'm just curious. No, I agree with you that the word tycoon is appropriate. I was just curious why you used it, just intuitively. I mean, David Simon is the son of the founder of Simon Properties, but he only owns like 3% of the company. The Kwak family that owns Sun Hung Kai, or started it and then listed it, they own just about 52% of the shares. So I think it is appropriate. They're mega billionaires, all of them, Raymond Kwak, all of them. And the people that buy the shares in the company are basically minority shareholders relative to the family. So I think it's appropriate. But that's just another way to be thinking about it. They are also certainly one of the largest landlords in Hong Kong, but they're also one of the more aggressive developer, builders, and landlords in mainland China, which are their only two markets. They're not all over Asia. They're just in Hong Kong. And this is, what are we looking at here? Tell us what we're looking at. Pardon me? What part of Hong Kong is this? This is their project here. You recognize it? Who's been to Hong Kong? I thought it'd be highly recognizable. But actually, all three of those aren't built yet, so maybe that's why you're having trouble. Although I think they are. The big one is, no, I think they're all finished. Well, so this is Central. That's the IFC Tower. That's the peaks. This is called Central, Causeway Bay, and then this is Kowloon. So that's where the old airport was, and they've just bought up all the land. And they've just done really well with it. That's their newest investment. But they also have a lot in the mainland. So that's Sun Hung Kai, a name some of you all are going, well, I never heard of that. $52 billion, and so Simon Properties, that was your guess. They are, yeah, okay, so they're number 3 on this one. This is November. These rankings keep jumping around, and this chart shows you 3 different spots in time. So it's a very busy chart. There's a lot of data on it, and I guess, Wayne, if you guys want, I'll give you the PDF if anyone's really interested to look at it. So this is the picture in November. Sun Hung Kai was definitely number 1 by a long shot back in November on the blue bars. You'll notice on the green bars, back in December '07, they also were number 1, so they've been number 1 for a while. And then things really got interesting coming into the new year. Westfield broke off a bunch of its divisions into a separate listed company. Simon is now up into the number 2 position, and until the earthquake, Mitsubishi was number 3. Mitsubishi's probably fallen 10% in value during the earthquake, even though the report I read last night said that none of their properties were damaged, none of them. Nothing structural that engineers have been able to find. Internal, pieces of ceiling tile or file cabinets, yes, but all those buildings in Japan, the remarkable thing, 9.0 or 8.9 earthquake, compared to, say, what happened in Haiti, not only is the death toll lower, but the buildings all are still standing in Tokyo, which was only 150 miles away from the epicenter. And in Sendai, a city of 1 million, one report I read said only 20% of them are damaged because they were built right. They were built for earthquake. But this is the list. This is those of you who are interested in the listed sector. You may be a money manager, you'll be a stock picker, you'll be an analyst, you'll be trying to figure out where relative value is the way our guys do. This is your university. This is your top. This is like your blue chip. These are the names that dominate the index that you take a big bet when you don't own them, and you want to figure out, do I overweight or underweight them in my portfolio? For those of you that end up in the stock picking world. And you'll see that, that there are a lot of names here that are Asian. And I think of the top 10, it was 7 out of 10. So whoever said, I think 6 or 7, somebody gets a gold star over there. But actually, this is not quite correct. It should say Asia Pacific, right? And they're not all China. Look, their Mitsubishi estate is Japan, and I got Westfield as Australia, so Asia Pacific would pick them up. And this is just another, this is the most recent ranking. This says as of February 5th at the bottom, but actually we updated it since March, so it's basically what it looks like. And Hutchison Whampoa is like 55 billion, but they're not all real estate. So these are starting to be big, serious companies that are in large cap stock indices anyway. Westfield is generally in the top 5 market cap companies on the Australian Stock Exchange. So it's a little different than here in the US, where our largest company, Simon, is in the S&P 500, but I think it's our only REIT that's in there now. Could be wrong on that, but I think that's right. They're in Russell 3000. We've got maybe, I don't know, 15, 17 REITs in the broader mid-cap stock indices. But real estate's a big, big industry. It's a big game in some of these other countries. It's got a lot of capital thrown at it. It's got a lot of capital to put to work. It's a very important and interesting part of the world. What I thought I'd end with was just a little blurb on the real estate index that we do called the Transparency Index. It's all up online. It's a big part of what I would say many of us who work in international feel like we're in. We're really in the transparency business. We're trying to take very cool stuff that locals have been doing for years and doing well without us. We're saying if you want to get bigger, if you want growth capital, you've got to get more transparent. You've got to start doing quarterly financials. You've got to stop paying bribes to the mayors. You've got to stop taking people out to Macau and giving them $1,000 to go gamble to lease spaces in your buildings, because we just can't work that way with pension fund money from America. Just to give you an example of a conversation I had to have with one of our joint venture partners not that long ago. Not me, but our colleagues. So this transparency index is our way of not saying countries that rank low on it are bad people or bad countries. It's just a way to say if you want access to global capital markets, these are the rules. And you don't have to follow the rules. And in fact, they're good investments if you don't follow the rules sometimes. But let me just share with you how it's put together. Here are the attributes. Investment performance. You think about how do you know to invest in stocks or not? Well, a lot of it has to do with the work that Roger Ibbotson and Bill Sharp and these gurus of finance did to figure out risk and return for stocks. We need that data for real estate. And when we get it, we generally will understand how our investments are likely to perform better. So we need investment performance indices. There are 7 different attributes of investment performance indices that we have in this index. Listed stocks, private equity, it goes on. Market fundamentals data, that's in there. The ability to get listed vehicles financials is a whole sector unto itself. And then regulatory and legal, 11 different variables. And professional standards and transaction processes, 7 variables. That's what those numbers mean. Those are the variables, the number of things that we're measuring. This is the map. We have not gotten to most of the countries in Africa. I'm sorry. We're working on it. It's hard. We need to work enough in a country to even figure out where we are. We haven't had enough assignments in some of these African countries to even know. But we've got most of the rest of the world covered now. Certainly most of Asia covered. We're missing some of the GCC, Gulf Cooperation Council countries, but most of South America, most of North America. This is the current ranking. U.S. is not number 1. We're not the world's most transparent real estate market in general. We think Australia is, but not by a lot. They've got more of their real estate in a listed vehicle, so you've got better financial data. You have better statistics on it. You also have a whole series of rules and regs there that are done more nationally or at a level that's better enforced than our state, municipal, federal system. We got a lot of crazy regulations in this country coming at us from all different areas. Just the time it takes to get permits, the time it takes to deal with lawsuits, our legal process is not very efficient. Australia trumps us on a lot of those things. And these are some of the countries that are moving up. Turkey, Poland. These are great countries to be looking at as an investor because as they improve, their cost of capital will come down. You can go in there with your expensive capital and then sell when the capital gets less expensive. What will happen? Cap rate compression will happen. You'll be able to buy at a 10 and sell at a 5. That's like every real estate investor's dream. What, 10% cap? 5% cap. That's what I'm talking about. I'm not talking about price per foot. You would not have done well to buy at $10 and sell at 5. But that's what happened in Shanghai. Shanghai went from a 10 cap market to a 5 cap market. Now the trouble was you couldn't buy too many properties at a 10 cap in Shanghai. They weren't there for sale. But you could build them and lease them, and your yield on cost was sometimes 10, 11, 12. So it's the same thing. At any rate, these are some of the concepts that I wanted to share with you on transparency. I think 10 years ago when I was last here, Wayne, I had just done the first round of it. We had just done like 12 countries. Now we've got, I think, about 55 countries in here. And this is the concept I was just telling you as an investor, why I care about this concept. I care about it because if I want to earn better returns in another country, I want to get paid for the risks of lower transparency and not knowing the rules of the game and dealing with weird customs that I'm not familiar with. And I want to be able to, over time, hopefully educate the rest of the world how this country works, so that it's not just little old me who's buying in Rio, but the rest of the world's buying in Rio because they can understand it. And if I'm one of the first ones into Rio and do well, and I'm just competing with the locals, and then I can expand and sell my property to an international marketplace because I've got 3 years of audited financials to show the next buyer, and I've got some great leases well documented, not just thrown in some file drawer to show the next buyer, I might actually get a better price. That's the concept. Does it always work? No, but it's worked for us a lot. And it's not just us as a company, it's an industry phenomenon. It's what happens when real estate itself has benefited from this. When real estate went from the dark ages of not being a very transparent market, even here in the United States, it lowered its cost of capital when it got access, when Moody's started to give triple, double A, and single A ratings on the debt that companies were borrowing in their real estate investment trusts. So it's the same process has worked here in the United States. It works globally. So that's pretty much where I wanted to end up. These are some of the ideas that we're sharing with our clients right now about where the good values are. We're talking about how the financial crisis is not over yet, and that there are a lot of gaps in the capital stack of real estate. Most capital wants to be senior debt and core real estate. So all the capital, all that liquidity is going to those two places. It's leaving some other areas alone, and that's creating some interesting opportunities. There are these other secular trends to watch too, like industry consolidation, the shift from defined benefit to defined contribution plans, and also the growth of sovereign wealth funds. These are capital market trends to watch. They all have implications for investors. The way we summarize these, and I'm not going to try to speak to it, is we put it all out in a matrix for some of our larger investors who are truly global. They're not US-based pension funds. I can't always mention their names, but, well, like the Canadian Pension Plan, they're a client. And they really like these charts because it helps them figure out where they're going to play the distress, where they're going to go for the capital gaps, that's what the middle ones are, where they're going to just be doing core, and where they're going to go for the growth. That's how that top axis works. They're going to use a geography overlay, and then we're going to start to tell them, this is a framework that we've designed for them, and then we're going to say, these are some of the bets we think you should play. These are really good opportunities around the world to start to go after because they've got really good risk-adjusted returns. And by the way, so there's some good number, right behind it, there's another batch of good things to do right behind it. So these are some of the things we're recommending to clients to sort of take all the cycle work that we did and try to say, where does it look good to us in 2011? As a couple of deal pictures to leave you with, right now in Europe, it's a low world. It's not a growth market. They aren't even having babies. They're not even having growth of any kind demographically, really. Why would you invest there? Because there's a massive capital gap going on. The German insurance companies and the German open-end funds are both on the sidelines, and the big German banks are getting ready for Basel III, and they're on the sidelines. And so German real estate is on a fire sale that we've never seen. German real estate is generally bought and held for 30 years. It's generally traded at a 5 cap or lower. This is the second largest mall in Cologne, Germany. We just bought it in October at a 6.9. We still can't believe we got it for that. There were 2 other bidders on it, but all the normal bidders were Germans. They were all hemorrhaging capital. The open-end fund who we bought it from needed the cash quickly. They went into their 40-property portfolio, picked out the best one because they needed the cash so badly. We got their best asset. We bid a 6.9, we couldn't believe it, we got it. Now a 6.9 in the US, that's not great pricing, it's decent. In Germany, it's fantastic. And when we were able to borrow, even though I said German banks are not lending, other banks are, and the Euro bond, at the time we put the debt on, was trading at about a 2.5, 2.6, and the spread over it, we basically were borrowing at about a 3.5 interest rate for a 5-year term on a 6.9 yield. You take a 6.9 yield, you put 50%, or what did we do, about 60% debt at 3.5, you have some very nice economics there. And we think we can get a 17 IRR and a 2x multiple, yeah, 65% leverage. So it's not like when you're going to Cologne, it's like the last property you're going to visit on your American tour. It's not a very, beautiful property. It's where a lot of Germans shop. Cheap and cheerful, they call it. It's just like basic real estate. These are some of our plays in Asia. We're even going before we did this before the earthquake. We were very worried about Japan. We're not overweight Japan, but we actually were saying for our more income-oriented buyers, we were underweight. We liked Australia much more. We love Singapore. We couldn't buy enough Singapore in 2010. We can't buy enough of it in 2011. We still like Hong Kong, though it's feeling very much like a bubble to us. And we think China, Tier 1 and Tier 2, is really not still safe enough for many of our pension fund endowment core clients. It's more opportunistic, and we've shifted out of China Tier 1. Liwan, just what you were saying, we're into Tier 2. We think that's a better risk return yuan. Now here's a final 2 pictures I'll leave you with, and it's kind of a tale of 2 cities. They've both worked out well for us. We went long Singapore, and it wasn't Singapore office. We've got a couple of those. It wasn't retail. We saw what they were going to try to do with their integrated resorts, which was to compete with Macau. 2 mega resorts, one out on an island and one right on the main bay there across from the office district. And they were going to open up gambling and build a very sort of Singapore clean, squeaky clean, Singapore style venue for gaming. So we got as much hotel under contract ahead of that as we could, and all 3 of these just were killing it. Swiss Hotel Merchant Court was the one that we bought first. It was a standing asset. The other 2 we developed. So all 3 have done very well. They've all played off of the fact that Singapore, which was not exactly Asia's biggest tourist city, it was a big financial center, but now it's becoming a tourist destination for middle-class Chinese and India people who are looking for a safe place to go where they can gamble. Their other big alternative in the region is what? I'm sorry? For gaming, for gambling. Macau, yeah. So we did Macau also. And there's our Macau deal. Looks gorgeous, doesn't it? 2 gleaming towers. You don't know Macau, maybe, many of you, but there's this gorgeous little lake here. The big TV tower is right here, and that's the hill, and then most of the Stanley Ho gaming, the Lotus, is here, and then the Cotai Strip is over here. So it's a really, you can't tell from this picture, but it's a great location. So we bought this land, and we got these great architectural renderings to show what we were going to build, and we did that in 2006. And these are still just pretty pictures. Neither one of these is built. And this is what you run into. So what happened there with us was the transparency problem. The head of the construction and permitting division in Macau for the SAR of Macau, Special Administrative Region, was caught taking bribes. He was thrown in jail for 25 years. He's lucky he didn't get executed, because other folks were, and he was not. And if you know the history of Macau, there's been a history of corruption there going way back. It was a Portuguese colony. There were actually gangs running the city for many years. And it got early into every vice you can think of, including gaming. And then when the Portuguese handed the colony back to the mainland and they came in and cleaned it up, they decided to keep it as a big gaming area and invited the Sands in, Steve Win-Win in, and Stanley Ho, who had the two biggest places. They let him get another license to build another gorgeous big gaming hall. And it's all working great, but the problem was the permit guys in jail, and we needed a permit. So we're doing well. The land that we bought has probably gone up 5 times in value, but that's not what we wanted to do. And the only reason that's a problem is we have a big Asia fund with tens of millions, hundreds of millions to put in. If you buy land for just, I think we paid about 40 million for it. It may be worth as much as 200 million today. That's great, but we had expected to put 100 million or more into these twin towers and make money that way and get much more serious money to work here than just the 45 million that we put into the land. I think, as I recall, because this is back in 2006, we had in mind going in, construction cost and everything in, something along the order, this was luxury resi, of 250 million in construction costs and selling for, very, very high numbers. But we're happy, but it's just a different wrinkle on what happens in these markets. So I probably used up all my time. That was actually my last slide, and we're at 90 minutes. Enjoyed chatting with you. Wayne, are we out of time? What would you recommend?
We always like to allow for questions.
I invited them along the way.
Right.
But if we have questions, I'd be glad to take them. Yeah. Yes? Yeah, yeah. Because we wouldn't be hanging on to the real estate. We'd be selling to bubble buyers. We'd be buying shares in a company that were selling condos to people that were overpaying. So we're not really paying the bubble price. We're buying shares in a company that are taking advantage of the fact that many mainland Chinese people just can't wait to buy a condo in Hong Kong. Now, not these guys, because they know too much. They're too smart. But a lot of others just seem to like that's nothing more they want to do. In fact, it's not even Hong Kong so much they want to do it. It's Shanghai they want to do it. In Beijing they want to do it. And they don't even want to live in the unit. Right? What is something like 25 million empty? Go ahead.
Market is pretty strong right now. As you said, sometimes you have to be waiting in line to buy a new condo.
So it is nerve-wracking, and it's something we would do in the securities area where we'd buy the company and then sell the company and look at their earnings, growth, and their ability to sell. We would never, what we have done is getting out of Shanghai and Beijing. We're over in Chengdu for our resi deal. And we're doing something in Dalian. And those are tier 2 cities, which are really not nearly as frothy. Okay? But it's nerve-wracking. China is a nerve-wracking country for a foreigner. Those Chinese have money. There's a ton of money in that country. They don't need our money. You've got to figure out something to do that, what do you bring to the table when they already have all the money they want? The developers have money there, am I right? They don't need American money. So it's a tricky market. It's probably our trickiest market. That's why on that little chart I had X's up there. It's not core. It's not for my teachers and it's not for Wayne's retirement account. It's not for TIAA, who's a client of ours. We wouldn't tell TIAA to invest in China for the long haul yet. In time, yes, but not quite yet. So you're safe, Wayne. Good question, though. Anybody else? Yeah, please.
That mall from Germany that you showed that you calculated a 6.9% return or yield. How do you factor in the resale price that you might sell that mall later on, 30 years from now, whatever? How do you put that into the calculation? or you just have calculated the rent or whatever income you get?
Well, there's a lot of moving pieces here, but just simplistically, it's working much the way I'm sure you're taught in your valuation class. You have your going-in yield, you have your leases expiring over the course of the hold, you have your going-out yield. As each lease expires, you have to put in an assumption, just as you would in an Argus model here, for what you think you can relet it at. And so it turns out, in our Argus model for this center, we dialed in 0 rent growth.
Again, do you think you're going to sell at a profit or loss?
Yes, because our big money that we think we can make is by going in at a 6.9 and selling at a 5.2, 5.3. Now we could get that wrong. If we get that wrong, we don't get the 17 IRR. If we get in at 6.9, we go out at 6.9, we're probably just going to get a 6.9. But this is actually a deal we did with the Canadian pension plan. They said, you know what? We're happy with the 6.9 downside. If you guys tell us that's really the downside. We said, yeah, we don't think this yield's going to go up anymore. We got it at this amazing situation where a German open-end fund needed cash, and like their key thing with us is, could we close in 2 weeks? We go, oh yeah, we can do that. So that, a little more flavor on that. Remember what I said before, German real estate like this generally is traded in the 5s or the low, in the low 5s or the 4s. And will that happen again? I don't know. I don't think so. We're not really counting on it. But one thing I do know is that there's a lot of regulatory change going on with German real estate right now. I won't get into it now, but all that regulatory change has the German domestic capital, which has been the major source of capital for German real estate for decades after the war, and even before the war, it's on the sidelines. So it's like the one chance a foreigner has to come in is right now. Okay? Okay.
Yeah, I want to ask.
You get the last question.
Thank you.
It better be a good one.
I hope so. To what extent does this investment management subsidiary still interact with its parent company, which is LaSalle? Because I know, like, for CD, it has a very similar subsidiary called like CD Investor.
Yeah.
But they don't really interact with very much with its parent company.
Well, I don't know how they would describe it. I describe it this way. It's not too different than the money management arm of JP Morgan that has banking over here and brokerage over here and then money management over here. You definitely benefit from what the brokers know, from what's going on with the bankers. They'll talk to you, they'll tell you what they can. They have confidential clients they can't tell you too much about, but generally they're pretty chatty guys. They're working on a lease in Shanghai. They're happy to tell you the 4 people that were interested in the space. And while they did the deal for a competitor of yours, they're happy to tell you there are 3 others that you should go get as a tenant. Without breaking any, rules of ethics. It's actually pretty much common knowledge a lot of times in the brokerage community who's looking for space. So we get a help from that. But over here on the investment management side, while we try to help them, we have to be very careful. On a lot of the work we do, it's got to be highly confidential. We can't let the brokerage banking market know that we're about ready to buy a property, do a lease, whatever. So we try to help them out wherever we can by giving them business. But what we try to tell our clients as a fiduciary is we're not just trying to create revenue for the services side of the business. The way we do that is we disclose. And we try to say in any report we put out, by the way, in the disclaimer here, 20% of our leasing business this quarter was done by Jones Lang LaSalle, 20% was done by CB, and 30% was done by some guy with a broker license or without a license or whatever. So we try to disclose that, is what I'm saying. So I say it helps to be part. I think CB, Richard Ellis, investors, and ourselves both benefit by having all this on-the-ground colleagues who can tell you rents, who can tell you who's looking for space, who can tell you if it's a good location or if it isn't, who can tell you if the developer's crooked or isn't. They have that same advantage we do. I don't think that a lot of other private equity firms have those same advantages, but if you're Blackstone, you may have other advantages that we don't, because you're running private equity. You may know where venture capital firms are expanding. You may know more about capital markets arbitrage plays than we would. So each firm, I think, in the investment management business tries to develop its own niche, its own comparative advantage, and so ours tends to be more on the brick and mortar real estate.
Sorry, so can I?
That was the last one. One more.
Yeah, can I just understand in this way? For example, like the market information gathered by the sale.
Yes.
I'm a like outside investor. I have to like pay some money to get the information, but for you guys, we can have better access.
Yes and no. I mean, you're an outside investor. Do we have special insider knowledge? Yeah, we think we do sometimes. It's not a perfectly efficient market. It's like on that chart I showed you before. We're like not totally as efficient as the stock market. We're somewhere in between. But real estate data is still private data, lease data. Buildings around here, you don't know. You can't walk around. There's no sign in the window that says, you know, these yogurt chain is paying so much in this rent. And this, you don't know that. Now you can do that in the bond market. You can look it up what the city of Gainesville is paying on their bonds, but you can't. It is a lot of private information. So does it help to be part of a brokerage company to help figure out what rents are? Yes, it does. Can others do it? Yes. All they have to do is tell my Jones Lang LaSalle colleagues, hey, tell us what the rents are, and we might hire you to do the leasing in our building. And guess what our brokers do? They'll chit-chat all day long, no problem. So it's not as private as it may seem. But okay, good question. So Wayne, I think that's my energy's out.
All right. Well, thank you for showing us.